Hello, ladies and gentlemen. Welcome back to Reserved Investments, and welcome to the next level of investing in the antiques and collectibles trade. For the uninitiated, this is a hardcore collectibles finance channel. It is non-hype driven. I'm not here to blow smoke up your proverbial arse, telling you what you want to hear. These are hardcore fundamentals that I teach on investing, speculating, and collecting items that make up the overall antiques and collectibles trade. Now today, we are going to be talking about a core concept that I've yet to cover on this channel, but I have hinted to it. That particular concept is known as the efficient market hypothesis. And we're going to fully define what is an efficient market. And more importantly, are markets that make up the overall antiques and collectibles trade, are those markets efficient or are they inefficient? Well, before we start, obviously we have to define what is an efficient market. Now, for those of you that are following along, if you look at the video description below, I am putting a link to an article that we are going to be covering on this particular topic. And this particular article first premiered on the website altoninsights.com. This particular article was published in March of 2023. So it is fairly recent, and it is by far one of the best articles, in my opinion, ever written on this core talking point. So we're going to go through, I'm going to read you this particular article, I'm going to define what an efficient market is, and then we're going to answer the question, are markets that make up the antiques and collectibles trade, are they efficient or are they inefficient, and does it even matter? Let's talk about this. So here we go. What is an efficient market? An efficient market is a financial market where prices accurately reflect all known information about the assets being traded. In an efficient market, it is challenging for investors to achieve excess returns consistently because any new information is quickly incorporated into asset prices, eliminating arbitrage opportunities. Now, what's an example of an efficient market? Well, obviously, the financial markets. Wall Street is a very efficient market. Now, there are exceptions here. For those of you that don't know this, one of my favorite movies of all time came out in the 1980s, and it stars Michael Douglas. That movie, of course, is Wall Street. Wall Street is the story about a fictional corporate raider by the name of Gordon Gekko who operates on insider information. Insider information as it relates to the financial markets, as mostly pretty much everybody watching this video already knows, is highly illegal because the financial markets are heavily regulated because they meet the definition overall of being an efficient market. Now, there is some disagreement on that core concept, on how we define the financial markets overall. I consider them personally to be efficient markets. There is some debate out there. That's why if you look up something called the efficient market hypothesis, you may come to a different conclusion overall. But in my opinion, Wall Street and the financial markets are, I'm not going to say a perfect efficient market, but they are an example of an efficient market because, again, there's a lot of regulation that makes up those markets. Now, on the flip side, if you get involved in the market for antiques and collectibles, if you get involved in the market for silver, gold, precious metals, even cryptocurrency, those markets are devoid of a lot of regulation. Insider trading in the antiques and collectibles trade is not illegal for the most part. Matter of fact, I make a lot of money engaging in what you probably would consider insider trading in the overall antiques and collectibles trade. People in the know can profit legally in this market because it is not regulated overall. That is something important that you need to understand. So, what factors contribute to market efficiency? Several factors contribute to market efficiency, including a large number of well-informed participants, access to relevant information, low transaction costs, and high liquidity. If you go back and reread that statement, that pretty much encompasses financial markets, Wall Street, stocks, bonds, mutual funds, ETFs, index funds, and the like. When these factors are present, new information is rapidly disseminated and reflected in asset prices, leading to greater market efficiency. Let's use this as an example. Let's look at Apple Computer. Let's say that Apple Computer is ready to announce third quarter earnings. They're ready to announce third quarter earnings, and Wall Street just opens, opening bell. Wall Street goes crazy because Apple announces knockout sales, meaning they had a banner quarter. Obviously, the stock price is going to reflect that. Most likely, the stock price is going to pop. It's going to go up in value on that news as more investors feel confident wanting to buy Apple stock. Now, in the antiques and collectibles trade, the markets aren't always as transparent. There's a lot of things that are happening behind the scenes. So if we're going to analyze a market like vintage comic books or Pokemon cards or rare coins, you're going to really have to dig below the surface. You're going to have to see what is causing that particular market at present time to either rise exponentially or fall. You're going to have to look at the core fundamentals. It's not going to be as clear as what's happening usually when we talk about Wall Street, when we look at stocks, bonds, mutual funds, ETFs, and the like. And this is something that you need to understand. So, how do collectible markets differ then from more efficient markets like Wall Street, like the market for stocks, bonds, mutual funds, ETFs, index funds, all those traditional asset classes? Well, collectible markets often have lower liquidity than more efficient markets like stocks. This is something that I've been preaching since the beginning of this YouTube channel. Make no mistake, if you go to the market today and you pay $5,000 for a comic book, there can come a point in time where you go to sell that comic book and you get nowhere near $5,000 for it ever again. A lot of great video game collectors right now are learning this lesson hardcore. Look what happened to the price of a lot of great video games just over the last year or two. A lot of people did not want to listen to people like me, people like Pat the NES Punk, people like Harry Rinker, people like Carl Jobst that were telling them something is amiss in this market, something's wrong. It looks to be alleged market manipulation. Well, now that the dust has settled and some of these great video games have dropped 40, 50, 60, 70, 80, in certain cases 90% in value, few people question it. People understand that there is something amiss in this market. This is something that you guys need to realize. For you to make money in the antiques and collectibles trade, you have to buy an item at a price point that is going to appreciate at some point into the future. It could be 3 months later. It could be immediately when you buy it. You buy it from one market and you sell on to another and you maximize a profit through arbitration. Or it could be 10, 20, 30 years down the line. But make no mistake, for you to make money in these markets, somebody at some point in time has to be willing to pay you more for that item than what you initially paid for it. Okay? This is vital. Back to the article. Liquidity can play a significant role in a collector's success or failure in realizing optimal value for their collectibles. Many collectible markets are beset by low liquidity, and that's especially the case in times of stress. This is why right now, if you don't need to sell certain collectibles, you should not be selling into this market. We are entering in or already in a downtrend in most pop culture collecting markets. In certain cases, there are certain individuals, if they buy right in this market, they will make a profit. The question becomes when, though, and what is the opportunity cost of holding that particular item? For instance, there's a lot of people that come to me through my consulting business. Shameless plug, email me at reservedinvestments@gmail.com if you want my assistance. And they tell me, Sean, I have this opportunity to buy this $10,000 comic book right now. And I think I can buy it. I can get it for like $8,500. Then when the market turns around, I can sell it into the market at a profit and eke out a gain. What are your thoughts on that? Well, to be fair, other asset classes are equally down. If you look at a well-diversified portfolio of financial assets, you could take advantage right now of putting your money in some of those particular asset classes. And when the overall economy then enters into a bull market run, you will be able to eke out those gains and profit from it should you want to. Now, is there risk in both those scenarios, whether you go into the overall financial markets or you choose to buy the comic book? They're both risky. We just need to look at opportunity cost. What are you giving up by tying up $10,000 of your money in a comic book at present time? That's how you need to start analyzing these markets from a financial perspective if you want to be successful. Additionally, collectible markets may have higher information asymmetry, where some participants have access to more information than others, meaning people like me, people who have been operating in these markets for decades. We understand the fundamentals of these markets and we profit off of those fundamentals. There's nothing illegal about that. That is information asymmetry. It means, in particular, all things being equal, if you're coming into the rare coin marketplace right now and you're going up against a guy like me who has decades of experience in that market, 9 chances out of 10, I'm going to be able to profit from your inexperience if I'm involved in that market. It's especially true if I'm a seller in that market. And again, this can apply to Pokemon cards. This can apply to comic books. This can apply to graded video games. This can apply to any market in the overall antiques and collectibles trade. The person with more information and knowledge always wins. 9 chances out of 10. There's always that 1 out of 10 chance that the person got lucky. But overall, if you possess knowledge, you know how to act on it, you can turn a profit in the antiques and collectibles trade. That's pretty much the core concept of this entire YouTube channel. All these videos that I put forth for you guys all come back to that one core talking point. Let's go on. Are collectible markets considered inefficient? Collectible markets are often considered less efficient than traditional financial markets like stocks and bonds. Factors such as limited liquidity, information asymmetry, and the subjective nature of valuing collectibles can contribute to this inefficiency. However, this does not mean that opportunities for profit do not exist. Rather, it suggests that pricing discrepancies may persist for longer periods, allowing for keen-eyed collectors to reap profits and rewards. Can market inefficiencies create opportunities for collectors and investors? The answer is yes. Market inefficiencies can create opportunities for collectors and investors to capitalize on mispricing in the collectibles marketplace. For example, if a collector has specialized knowledge about a specific category of collectibles, they may be able to identify undervalued items and profit from their eventual appreciation. However, it's important to exercise caution and conduct through research, as inefficiencies can also lead to risks and uncertainties. This article should give you all you need to understand about how to look at the antiques and collectibles trade from the perspective of this being an inefficient market. This also, connecting back to a lot of my earlier points that have been made throughout other videos on this particular YouTube channel, this is why a core financial plan should consist of mostly traditional financial assets. You then diversify into alternate asset classes like antiques, collectibles, precious metals if you so desire, and or a cryptocurrency. I do not recommend cryptocurrency. That's all I'm saying. But make no mistake, if you don't understand the efficient market hypothesis as it relates to the antiques and collectibles trade, and you don't even understand the point where collectible markets by their nature are more inefficient than that of traditional asset classes like stocks, bonds, mutual funds, ETFs, and the like, you are already behind the 8 ball. This is why so many people do not succeed in these markets. You cannot put all your money in non-income producing speculative assets. If you want to know what a non-income producing speculative asset is, simply look at some of the alternate asset markets I just named, mainly antiques, collectibles, precious metals, and cryptocurrency. This is why so many young people are unable to build wealth. This is one of the reasons. Thank you for watching. The link to this particular video, or I should say article, is in the description below. Please let me know your thoughts in the comment section below. Have a good night.